right, market structure. So our journey can begin. So first off, in market structure, it is very important to understand what I'm talking about. This is not your typical market structure. It's very simple in a sense. So I'll try my best to make it as mechanical and as easy as possible for you to understand. First, it is important to understand what we are working with. When I talk about market structure, I'm of course talking about swing highs. So a swing high, again, I reckon before you joined the mentorship, you already knew what a swing high was. So a swing high is, for example, that swing high and that swing low, right? I don't need to go in depth on that. Now, the first thing to understand is that we are working with intermediate term highs and intermediate term lows, and or we are working with short term highs and short term lows. When we are taking a range from an intermediate term high to an intermediate term low, or vice versa, from an intermediate term low to an intermediate term high, we are working with an intermediate term range. When we are working with short-term high to short-term low, or vice versa, we are working with a short-term range. So that is very important to understand. Now, if we keep that there, and when we are talking about an intermediate term high is a high that has to the left of it a lower short-term high, so just one singular swing high, and to the right of it a lower short-term high as well. Intermediate term low is the exact same, where we have a swing low, and to the right of that, higher to the right of that, there's another swing low, aka a short-term low, and to the left of it, there's also a higher short-term low. In this case, this is still a short-term low. What you would do here is you just pick the short-term low to the left of it. So this is still an intermediate term low. So that is something to be aware of. Just because there's no short-term low in this leg lower right there, doesn't mean that this is an intermediate term low, because I always see it as intermediate term highs and intermediate term lows. They're outsiders. So this, for example, is an outsider. When you draw on your chart, you can see that this is, for example, a clear intermediate term low, because that is an outsider. Then afterwards, we draw it from that high, because that's an outsider. Then this, because this took out short-term lows right there, that is a new intermediate term low, and that is also an outsider. Then after, right now, we have not created a new intermediate term low. Now, where can intermediate term highs and intermediate term lows form? That's very important to understand. When we are moving here, and we are moving higher, and we have this first leg higher, this is your intermediate term range, from that intermediate term low to that intermediate term high. Then we have a retracement. Once we have this retracement, an intermediate term low can form. Only once we now take out this high, only after taking out that high, a new intermediate term low can form. It's the only way possible. So this, for example, this low is not an intermediate term low. What that means in the bigger picture is that the short-term lows, so every low that is in between this intermediate term low and the intermediate term high, is not protected. The only protected low in this case is this low. You would not expect this low to go. So when we take out that high, and again, that intermediate term low is getting respected, or we wouldn't expect it to go once we take out that intermediate term high. So only once we take out that intermediate term high right there, and we have a retracement, something along the lines of this, then we would not expect that low to go. So sort of a market structure wise, that would be your last line of defense. Now, it's also important to understand where short-term ranges will form. Short-term ranges will form in between going from an intermediate term low to an intermediate term high. So all these swing lows right here, they are short-term ranges. Now, a short-term range must have This is very important to understand because it's the basis of everything. A short-term range must have a fair value gap in it, always. Mandatory, always. So, right here we have a fair value gap. Now, is this a short-term low? No, this is a potential intermediate-term low. How can we know that this is a potential intermediate-term low? Because there's an ST. An ST is what you will be using as your reversal pattern. Whenever there's a reversal in the market, there's an ST. An ST stands for sharp turn. Now, if my accent is in the way, let me write it out for you. A sharp turn, or in other words, an ST. That is what you'll hear me talk about a lot throughout the videos. An ST is not just a fair value gap higher when we are looking for bullish prices. What I don't mention on my YouTube is that an ST also needs to have a displacement lower. Otherwise, it isn't a sharp turn. So in this case, we have this displacement lower. What is a displacement? A displacement is a fair value gap. A fair value gap equals displacement. Displacement equals fair value gap. So whenever you hear me talk about a displacement, it's a fair value gap. When I talk about an ST, I talk about a displacement in and a displacement out. Because you're not just trading STs in the middle of nowhere. For example, this could be an ST because we have displacement in, displacement out. But into what? Into a PD array. There's no PD array right there that we can work with. So that is not an ST. So if we make it a mechanical step, an ST is you have a PD array that you want to trade off of. Then it's displacement into the PD array and displacement out of the PD array. That is your ST. So, for example, if we take just as example, don't take this PD array seriously. This is just an example right here. If we take this PD array, for example, that is not a PD array I would normally take because normally I would go up in time frames and see what are we working with right there. That is not a PD array I would take right there, but just as an example, please understand that. Then you would wait for a displacement into that PD array. So into that discount array right there. A displacement in the form of that fair value gap. And then you would want another displacement out of the discount array in the form of that fair value gap. That is your ST. That is a sharp turn. Now, there are very beautiful STs and there are very ugly STs. For example, a thing you will notice a lot is that STs a lot of times will have overlapping fair value gaps, aka a balanced price range. Now, is that important to know what a balanced price range is? I'll explain it to you, but it's not important to know. These overlapping fair value gaps and the part that is overlapping, so this is the part that is overlapping, that is a balanced price range. That is not important to know. An ST, ideally, in an ideal world, would have a balanced price range, so overlapping fair value gaps. But that doesn't need to happen because you also have ugly STs, as I like to call them. For example, if this was a premium array, just like that, just for example's sake, we didn't have a clear premium array, but just for example's sake to get the ST into your mind. Then right here, if this was a nice premium array and we were looking for shorts off of that, then right here, once we have this displacement higher into the premium array, that is already the first step done. Then the second step is displacement out of the premium array, right there. That is an ugly ST. Why is that an ugly ST? Because the fair value gaps are not overlapping, but it's still an ST. Now, there's a difference between STs like this and an ST where we have a consolidation and fair value gaps. That is something you will also notice throughout the forecast, etc. You will sometimes have STs where we displace out of a consolidation instead of a sharp turn. Those are my least favorite STs. Whenever we have a consolidation, for example, we have a discount array right there, and we have an ST into it, and we consolidate a long time, and we have a fair value gap higher, that is my least favorite ST because it defies the whole premise behind ST. And ST stands for what? A sharp turn. Is that a sharp turn? No, it's not. So there's a beautiful ST, your ideal ST, which has a balanced price range. Then there's an ugly ST, which has what? An ugly ST has a sharp turn, but the fair value gaps are not overlapping. And then you have almost a disgraceful ST, where there's a consolidating ST, where you have displacement in, consolidation in between, and you have a displacement out. That's your least favorite ST. So, the short-term ranges, or sorry, let me go over the intermediate-term low because we were talking about ST. Whenever we have an ST, there is a high likelihood that there's an intermediate-term low forming right there. So this, once we have this ST right there, because we had that fair value gap and we also had that fair value gap, that is your ST, then this is an early indication of an intermediate term low. So whenever, again, we are not getting into trades or entry types just yet, but whenever you would enter off of an ST, for example, then that would just be sort of you're predicting that you're trading off of an intermediate term low right there. You're predicting the making of an intermediate term low. Now, what is the confirmation of that intermediate term low? The confirmation of that intermediate term low is once we have a short-term range. So that short-term range ideally needs to come into a discount array in the form of either a fair value gap, a swing low, any kind of discount array right there, and needs to have a new displacement higher. Because once we have that new displacement higher, that is indeed a short-term range. Because remember, the short-term range needs to have a displacement higher, needs to have a fair value gap. Once we have this range right there, that is your short-term range right there, which already confirms as well the intermediate term low right there. Perfect. Then as well, what you may have noticed, you would draw your Fibonacci if you are going to use them, and I will tell you as well when you wouldn't use that ideally, is you would draw your Fibonacci from the most recent swing low to the most recent swing high, and you would expect a move into a discount array right there, close to the 0.5 level. Now, that is not always the case. If we follow along, we see there it is the case. It doesn't have to come into discount. You need to remember that. It doesn't have to come into discount as long as there's a fair value gap close to discount, or any discount array that is close to discount. If it's just above it, that's also fine. Same for there. Now, this is actually an example. This is rare, very rare scenario right here. Why is this rare? Whenever we are close to the drawn liquidity like this, and we can define close by having a swing grade on our chart right there. If we are at the 0.75 level right there, then you would not really expect price to come all the way back into an overlapping PD array right there. So again, let me make that clear. When we are close to the drawn liquidity right there, we could also expect just a move, and I would prefer this actually. I would prefer just a move into the discount array right there, into that fair value gap, and then we continue higher. So just a sting into the fair value gap, and then we continue higher. That's what I would prefer. This, in my opinion, is low probability right there when we retrace into an overlapping PD array right there. So that is something to take into account. Now, again, do you need to use your premium and discount right there? You don't necessarily need to. Let me tell you why. Because if you're just using overlapping PD arrays, then it's also fine. Because you can also tell that every time we come back into discount, we are reaching for what? An overlapping discount array. An overlapping discount array is an order block, a breaker block that is overlapping with a fair value gap. That is two discount arrays always. and right there as well. So that way you don't need the premium discount necessarily. So right there, once we have the short-term range to work with, this is your short-term range right there, just to show it to you that that is the short-term range. Then afterwards, once we have a new fair value gap higher as well, and we create a swing low in a discount rate, we create this swing low right there in what? In that order block right there. So, and in that fair value gap as well, because that's the overlapping PD rate. Then afterwards, we have a new displacement higher. Why? Because we have that fair value gap. Once we have that right there, then this low is now your protected low, right there. And once we have a new displacement higher, then this low is now your protected low, right there. And then once we have a new displacement higher, then this low is your protected low, right there. Until when? Until we take out that intermediate term high right there. Once we take out that intermediate term high, not a single of those short-term lows are protected now. Not one of them. This one is not protected, this one is not protected, this one is not protected. The only low that is now protected is that intermediate term low on a daily time frame right there. That is the only one that is protected. And the intermediate term low is usually the low that is responsible for stinging into a discount array. That is where your ST forms, because you need to have a PDA, displacement in, displacement out. That's how we view that. Now, the beautiful thing about this all is that you're always trading short-term ranges. And let me explain why. Because whenever we take out an intermediate term high, we take that intermediate term high. On the higher time frame, what is that? That is just a short-term high, right? And what are you doing after we are taking out an intermediate term high or a short-term high? You're expecting a move back into a new discount array. So what I mean by that is whenever we take out that daily intermediate term high right there, you would zoom out, and right there, you have a new weekly fair value gap that is overlapping with that old short-term high right there. Because you would expect ideally a move back into this range right there, which is your intermediate term range on a daily time frame. So once you have that, on a weekly time frame, all that you're doing is you're trading short-term ranges. So that is how you combine the time frames. And then right here, once you get into that weekly fair value gap right there, then you guessed it right. What are you doing? You're trading new short-term ranges off of that weekly fair value gap to that short-term high on the weekly time frame, but intermediate term high on the daily time frame. How can we confirm that this is an intermediate term low now? On the daily time frame, we have discount array, displacement in, clear displacement in. Why do we need a displacement in? It's very important to understand the reason why we need a displacement in. Price is tricking people into the market there. How many people do you think were tricked into the market right here because they saw displacement lower? They saw fair value gaps lower. They saw momentum lower. Maybe they didn't even know about fair value gaps, but they just saw momentum lower right there. And they thought, oh, this is definitely going lower. And then all of a sudden we have a displacement higher as well. Boom. Picture perfect. Because now people have been tricked into short whilst we are going long. That is exactly what you want. Now, the first fair value gap. Is this a fair value gap? No, it's not. Again, if I need to zoom in for a fair value gap, I usually don't use the fair value gap. If the fair value gap is that small that I need to zoom in to see it, so I need to do all the way like this to see it, then I usually don't use the fair value gap. I would prefer just my normal chart and I can spot the fair value gap easily. Now, this right there is an ugly ST. Remember the three classifications that we had? We had a beautiful ST, balanced price range. Let me write that down actually. One beautiful ST is a BPR balanced price range ST. Then the second one is an ugly ST. It's just your FVG in and your FVG out. Doesn't need to be a BPR. No BPR. Then the third one is a consolidation. So it's a rangy ST. All right, perfect. So this is a second tier, you could say. This is your ugly ST right there, where we have displacement in, displacement out, but no BPR. We have the BPR right there, but for it to be a tier 1, I would want that lower fair value gap right there. That last fair value gap that displaces into the PD array. I want that to overlap with another fair value gap. So, perfect. We do have an ST. When is that intermediate term low confirmed? Is when we have a new short-term range higher. So you can already tell, is this already an intermediate term low just because we have that swing low for me? No, it's not. And that's where the details come in, because we didn't have that ST yet. Once we have that ST and we have a new retracement into a discount array, doesn't matter, any discount array, that order block doesn't matter, as long as now we have a new displacement higher. That displacement higher, that confirms your intermediate term low right there. Perfect. And then the short-term ranges will hold until when? Until we reach that intermediate term high right there. And once we reach that, then we zoom out again, and we don't stay on the same time frame. With zooming out, I mean you're going up in time frames, because then all you're trying to do is trade the new short-term range again that you had established on the weekly time frame. Because all you're doing on this weekly time frame is what? Short-term range right here, short-term range right there, short-term range right there, and all you're looking for is a discount array that is in between that short-term high and that short-term low right there. So in between this area, and that is your discount array with that overlapping order block, and that is where you want to get involved. That's all you're essentially doing. With that new weekly fair value gap, and all you're trading is that new short-term range, which on the daily creates, of course, an intermediate term low. Now, again, this is a very ugly ST because we didn't even have the time to create a bearish fair value gap right there. But if this is now an intermediate term low, what do we need to have? We need to have a new retracement into a discount array, and then a new short-term range higher, so a new fair value gap higher right there, which creates a new short-term range, which creates and confirms the intermediate term low right there. Why is this also an intermediate term low? Because remember what we talked about in the beginning. An intermediate term low forms after taking out an intermediate term high right there. It can't form in the middle of moving from that intermediate term low to that intermediate term high right there. That can't happen. Now, the reason why we use that weekly fair value gap in the form of that, and we're not just trying to trade the daily here, you're making it yourself very easy if all that you're doing is you're following short-term ranges. All that we are essentially doing, that's the whole sauce. You can stop the mentorship now. Thank you for listening. No, no, but all that we're doing here is you're essentially following short-term ranges. The most important part, though, is that you're figuring out how to combine the time frames, which is also something we will go over. You need to combine the time frames correctly, because then you can achieve something beautiful. Because then all you're doing is you're trading short-term ranges constantly. It's that easy. It's absolutely mind-blowing, right? It's beautiful. I love it. So that is exactly what you would want to do. So the intermediate term lows, the intermediate term highs, are they relevant? Yes, somewhat. It helps navigate price on your entry time frame. Now again, we are not getting into entries until the second week, which is the execution week. But that is important to understand. Essentially, what your intermediate term lows and intermediate term highs are for is to understand your entry patterns. To navigate price on the higher time frame, you don't need it. That's the funny part. And that's what a lot of people don't understand, that you don't need it. And again, I don't classify a swing low that is rebalancing a fair value gap. For example, that swing low is rebalancing this fair value gap. That is not an intermediate term low. The intermediate term low, intermediate term high are just the swing highs with just a lower swing high to the left of it and a lower swing high to the right of it. Short term high are very specific though, because they are essentially coming into a discount array and displacing higher. So they are coming into a discount array. Let me define that as well for you. Discount array or any PD array. Let's take any PD array and FVG higher/lower. That's a short-term high. That's a short-term high. That's how you define short-term ranges. So now we have gone over intermediate-term highs, short-term highs, and short-term ranges, short-term lows, everything there. ST, sharp turns, is what we've gone over. Intermediate-term highs, again, I've just a checklist here just to see if I've talked about everything that I need to talk about. Intermediate-term highs and intermediate-term lows is not that relevant. The short-term ranges and fair value gaps are the most important part. Combining the time frames is what's the most important. The intermediate-term highs and intermediate-term lows is just to show you where the first potential move might happen. It's just to show you that this could be your first potential entry. But other than that, it's not that relevant. It truly isn't. You could even classify this just as a short-term range, short-term range, short-term range. But again, we don't do that. We classify this as an intermediate-term low. Then this is your intermediate-term range. So essentially, when you would expect an intermediate-term range to hold is when this intermediate-term range that we have right here has what? Has on the time frame above it a discount array right there, and just continues the short-term range right there. This is just continuing the weekly short-term ranges right there. That is exactly what you would want to see. So when we're moving from intermediate-term high or from intermediate-term low to intermediate-term high, that is when you would expect short-term ranges to hold. Which are, short-term ranges are essentially just if you dive into the lower time frame, so the time frame below it, that is where your intermediate-term ranges are. So when everything like that is in context, that is exactly when you expect intermediate-term ranges to hold. But when you're expecting intermediate-term ranges to hold, you're also expecting short-term ranges to hold. Because this is an intermediate-term range, but on the higher time frame, on the time frame above it, it's just a short-term range. So whenever you're expecting a short-term range to hold, you're also expecting some kind of intermediate-term range to hold. Does that make sense? I hope that makes sense, because it's just the same. They are equal. It's the exact same. It just depends on which time frame you are looking at. So all your average trading is constantly short-term ranges. That is the focal point. That is the most important part. Short-term ranges. The intermediate-term lows, intermediate-term highs are just telling you where the potential new move is happening, where we need to pay attention, because that ST, that intermediate-term low, is just a signal. It's an alarm goes off. All right, now we need to pay attention because we can potentially get involved in the market. That is how I view that. Then, like I mentioned as well, what I've written down, the intermediate-term high / intermediate-term low are really only relevant when going into the lower time frame. Because then you get to your entry pattern, etc. That's when they do get somewhat relevant. Now, again, like I mentioned as well, PD arrays, they don't really matter for now. Once we get into order flow, PD arrays will be more important. Now, the thing I want you to understand is whenever, so for example, let me find an example right here. Whenever a short-term range gets disrespected. So if we take this example, we have a short-term range right here, right? We have this short-term low, this short-term low to that short-term high. This is your short-term range. You would expect that short-term range to continue higher until that intermediate-term high right there. Then right there, once we move higher off of that discount rate, again, this is something we will go into deeper in order flow as well. We're moving higher off of that. On the 4-hour, it is important that you don't get blindsided, because this is also a short-term range, right? This right there is a short-term range. This short-term range you would expect on the 4-hour to hold, right? You would expect that to hold. But remember what we just talked about. Whenever we take out that intermediate term low, or we have this intermediate term low, and we take out that intermediate term high, what do? You zoom out again. You zoom out because the 4 hour needs to be in context of that daily. So that daily you can already tell, hey, there's a fair value gap forming. So this short-term range, whenever there's a short-term range getting taken out, it's likely there's a PD array, either above a short-term range or below a short-term range. So if we're going higher and we have a short-term range and we have a PD array, a discount array, below a short-term range, then you can't really expect that short-term range to hold. It's not as high probability. So in that case, again, just for your notes, this is not something that will make sense right now. But for a filtering process, if you have a situation where you have a short-term range, for example, right here, and there's on the time frame above it a discount array hovering just below it, then is that as high probability as another pair where that doesn't happen, where we just have a short-term range without a discount array hovering just below it on the time frame above it? Of course, you would take the one where we don't have that discount array hovering below that short-term range. That is important in combining the time frames. You're combining the time frames right there. And essentially what you're doing is you're not only zooming out when we take a short-term range, right? Or when we take an intermediate term high or an intermediate term low. No, you're also zooming out and you're being aware when we take out that short-term high or short-term low. The only difference is when we take out an intermediate term high like this, you would zoom out. When we take out a short-term high, you wouldn't zoom out. You would stay on the same time frame, but you would expect a retracement. But the retracement is not as significant because you don't have a lot of candles to work with. So that is how we go over that, and that is when you can expect ST ranges to hold and when you can also expect ST ranges to fill. That is very important. Same exact scenario what we had here. We had short-term ranges higher here, but on a weekly, we are just following this short-term range still. This one right there with that fair value gap right there. So you would not expect that daily one to hold right there. That is very important to understand. Now, then the next episode is about order flow. Order flow is diving into the short-term ranges even deeper, into the PD arrays even deeper. Understanding an ST, a sharp turn, is very important for your order flow. So again, if we go over one more example just to reinforce the idea into your head as well, I think that's very important. Then here on a weekly basis, we are just trading this short-term range higher, right? We are just following the short-term ranges because essentially what we're doing is we're targeting that intermediate term high, which on the monthly is potentially just what? It's potentially just a short-term high. And we're just following short-term ranges right there, right? So on a weekly basis, right there, we have this fair value gap. Again, you don't need to know why we thought, all right, we are potentially moving higher from there. That's order flow. Then right here on the daily time frame, we can already see, all right, we have this intermediate term high forming potentially. Then on a 1 hour time frame, you don't need to know why I'm going into the 1 hour time frame just yet. I'm just going into the 1 hour time frame. You don't need to know why just yet. What you would want to see here is an ST, so displacement into that PD array. Everything that's to the left is not relevant at all. All this sweeping, all that liquidity, that inducement, not relevant at all. Again, it might be relevant on a level where you need liquidity, blah, 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 but you don't need to pay attention to it. You don't need to pay attention to it at all. So please don't. So right here, if we just ignore all the left stuff right there, we have a displacement into the discount array. Then we need what? A displacement out of the PD array. So right there, we have a very fair value gap right there. That is your ST. So now a signal goes off. Boom. All right, interesting. We have a potential intermediate term low right there in the making. When is that intermediate term low confirmed? Once we have a new displacement higher. This comes into a discount array. New displacement higher. Perfect. That is your intermediate term low confirmed. And this is now your short-term range right there. right there. Perfect. Once we have this new swing low formed right there in the discount rate, we have a new displacement higher. That is now your short-term range and your short-term low right there. Same for this right there, because there is your discount rate and we are coming off of that order block and that fair value gap right there. Then afterwards, we have this new short-term range. We're coming off of that breaker with the fair value gap, new short-term range right there. And then afterwards, we have this short-term range right there, which is getting swept during a news event, which is not that crazy to happen right there. And then, of course, you're just targeting an intermediate term high. But what is an intermediate term high? It's just a short-term high on the time frames above it. So that is very important to understand. What you would do after this, you zoom out again, because if it's an intermediate term high, you zoom out. If it's a short-term high, you don't zoom out. Unless if we had, for example, a 4-hour fair value gap in this leg higher, and we were coming into that, then of course we want to be aware of that, because that is when a 1-hour short-term range can get swept. Because if we go into the lower time frame, then right here you will obviously see here ranges are getting swept on a 15-minute because there's a 1-hour discount rate below it. So that is when short-term ranges won't hold. And that is very important to understand. So essentially, again, summed up everything, what we are doing is we are constantly trading short-term ranges. And you know it's a short-term range because you're combining the time frames correctly. You're making it yourself extremely difficult if you're going into the 5-minute and you're trying to trade intermediate term lows constantly. Because the places where price can go higher from, right here, is harder to tell than just having this 1-hour short-term range right there, because there's only one place right there where price can go higher from. So you're making it yourself very easy. So this is full market structure, how we use it. Remember the ways we use it. So please, if you watched it, if you've watched this, I wouldn't expect any questions on the long-term lows, long-term highs. We don't use them. All right? No, don't worry. If you have any questions, then please do ask them. All right? All right. Perfect. Thank you.